The 2008 financial crisis was a massive economic downturn that changed the way we think about banking and global markets. It all started with home loans. Banks were lending money to people who struggled to pay them back, creating a bubble. The collapse of that bubble triggered a deep recession, costing millions of Americans their jobs and their homes. Risky loans were bundled into complex investments that banks and investors bought, thinking they were safer than they actually were. Post-crisis regulations changed everything. Banks now have to hold more cash in reserve to handle potential losses. You can see the economic impact clearly here as GDP growth turned negative, marking the official start of the Great Recession. The biggest lesson learned was that when financial products become too complex to understand, they often hide significant risks. Understanding these cycles helps us make better sense of today's economy. Thanks for watching, and keep learning about how money works.